Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Right, so hi guys, welcome back to lesson 10. We've come a long way. Covered lesson 9 the other day, and here we are looking at lesson 10. Now I hope you guys have built, I hope you guys have built a very, very good knowledge base. Sorry guys, I'm drinking my usual yerba mate, or tereré as they call it in Paraguay, mate in Uruguay, but there you go. I absolutely love this stuff, so I'm overdosing is the word on it, and yeah. But in any case, guys, back to the lesson. We're here at lesson 10, and for those of you who it's the first time maybe seeing this on the channel, we are covering perhaps the biggest free YouTube education program that you're ever going to see, covering multi-asset, everything you need to know. What I teach you here is largely something that I think you're going to be able to take for the rest of your life. I'm not going to teach you about stuff that that's going to essentially break your bank and you're not going to make anything. There's a lot of stuff already on YouTube like that anyway, so you can go and take any of the other stuff you see online, and you know, no one's going to teach you anything proper, right? I mean, I know there are a few people trying to do some good stuff around this, but in reality, you're not going to get any good education. So in my opinion, putting it all out here for you to see is really important. There are some nuances, and you know, we're going to explore that as after we finish this course. So the idea is that we're going to have we're going to cover multi-asset in its entirety, so at least you've come from now at this point, you've come in from a beginner to someone I think is going to be a proficient trader, at least where you can understand what's going on in the market, and you don't need to ask anybody anything. You don't need to go to forums. You basically can just treat this as a one-stop shop. Once we complete this section of it and we've covered everything and we're sure that you're now well based, we will then progress on to having individual lessons that are maybe related to a specific subject standalone, right? Where I teach you how to, say for example, volume price analysis, give you a more in-depth lesson on that, and we're probably going to do it dynamically, so at least I can now just sit in front of a chart, explain stuff without worrying that maybe this is all new and it's going over your head, which is the largest complaint when you're trying to learn how to trade. You go on YouTube, you find a lot of things that just go whoosh over your head, and you're thinking to yourself, but I'm just a beginner. I mean, I don't even know what a futures contract is, or I don't even know what an options contract is, or I don't know, you know, what's the difference between a spot price or a futures price, or what a delivery date is. So, you know, so you're trading things that people are showing you little technical things online, but you don't know what you're doing. You're just doing basically what you see, and that leaves a lot of knowledge gaps, and these things are going to trip you up, right? When you go to do technical analysis, you see like a myriad of things. I mean, at the end of the day, there are myriad ways to approach the market, but there's a way that you can make it simple, a little bit more structured, and you're going to get incredible results. But if you don't have that foundation on that basis, it's going to be very easy for you to be led astray. So anyway, let's dive into the lesson. This is quite a long one. It's quite a packed one, so I'm not going to waste too much time. Okay, so I wanted to talk about derivatives, right? Because a lot of people are trading derivatives. It's insane. There's so many retail investors trading derivatives, and they have no idea what these things are, how they work. There's so many people, whether it's on the regular MT4 platforms, or whether it's on more bespoke stuff like Sierra charts, or whether it's on CQG, whatever. There's so many people trading derivatives and they don't even know what a derivative is. So I'm going to start from the beginning with derivatives, and I'm going to give you an idea of how this works. So what are derivatives? Now, a derivative is a contract that derives value from the underlying asset it represents, right? So what we're saying here is that, let's say you have 5,000 bushels of corn. That corn is the asset, right? 5,000 bushels is the real asset of corn. Now, of course, you don't have 5,000 bushels at home, but how about I write you a contract that entitles you to buy 5,000 bushels today at a specific price to be delivered at some future date to be decided, right? So that's kind of a derivative contract that's been drawn up. It's drawn up and it represents the value of the underlying asset. So if you were to sell that derivative contract to someone else, then technically they have now acquired the rights to that asset, right? So that's kind of what derivatives do. They allow you to be able to, in other words, make the asset liquid, so movable from one person to the next without necessarily having to move the physical asset itself, right? So derivatives allow for these kind of things to occur. I mean, there have been, in the past, there have been some issues with derivatives in general. Very classic case. I think I've even mentioned this story before. Some of you might have heard this from me, and you just need to Google. Actually, I think there should be some articles about this, where there was a particular investor called Shami Ahmed, and this gentleman was able to acquire near controlling interest in certain major high street firms at the time using contracts for difference, right? So in a way, this is kind of a derivative because it was allowing the person to control a certain amount of shares using a contract for difference, for example, right? So derivatives are just that, essentially, right? They're pieces of paper that represent the underlying asset that they derive their value from. So another example is an option contract. Options are derivatives, right? So they give you the right, but not the obligation, rather, to buy an asset. So for example, 100 shares of Apple, that essentially that's one option contract. So someone can write an option contract that gives you the right but not the obligation to buy Apple shares at a specific price. Okay, and when we come to options, we'll talk a lot more about this in depth, but for now I don't want to get into that too much. There are different types of derivatives. Futures, of course, which we are going to talk about in this lesson. There's options and there's also swaps, but we won't get into those today. Why trade a derivative? Well, there are a number of reasons. First and foremost, you can use a derivative to hedge asset exposure. So let's say you owned a certain amount of shares, and you essentially want to have insurance against those shares. Then you might be able to look at what we call put options, right? So you might buy a put option, right, which you're going to get a premium. Let's say that, maybe, let's say, I'm going to, hypothetically speaking, let's say you have 100 shares of Apple, and then you want to protect against a potential decline of Apple. You want to protect up to a certain price. Then you might say, well, I'm going to buy a put option in the case that Apple drops below a certain price. I can then use that put option to kind of cover some of the loss I might get, seeing I actually own Apple shares, right? So that's a hedge. That's kind of a hedge, right? That's what a hedge is. So you're using the Apple options, those derivatives, to insure yourself against potential loss, right? So that's why a lot of the time you'll hear options referred to as insurance. There are other complex strategies you can do with these insurance policies, which are options, right? Or these option derivatives. Another thing that's quite common is that some people will sell option premium against existing stocks that they hold, right? This is what's called, for example, you might hear when we come to talk about options and option spreading, you might hear someone say they've got covered calls. Warren Buffett is obviously one of the people who actually employs this strategy a lot, where they sell covered, they sell options, right? So they sell covered calls. So essentially, let's say you have 100 shares of Apple, and you sold a call option against those 100 shares. Well, in reality, it's covered because you have 100 shares. If Apple was to decline or was to go up in value, then you have the 100 shares, right? So you benefit. So you don't necessarily need to worry about the short call, right? And we'll talk a lot more about this. So if I'm using language you don't understand, don't worry about it, right? So again, those are at least two examples of how people could sell options and buy options in order to enhance or protect their portfolio position. Right, so derivatives are very, very interesting products, right? And a lot of traders tend to trade them. Whoops. So we're going to start with futures derivatives, right? So what are futures? Now, futures are forward-looking contracts that allow parties to agree a price today for future delivery of the underlying asset, right? So these delivery dates can be 1 month, 3 months typically. Some futures are cash settled, like index futures, right? And we'll talk a little bit more about this. So futures are forward-looking contracts. So what does that mean? All right. Like the example I made previously, right? If you bought a futures contract for something, you're basically saying that I will purchase this thing now at this set price, but this asset needs to be delivered to me in a month or 3 months time. That's what we mean by delivery dates, right? And all futures contracts you trade have a delivery date, right? When the underlying asset is to be delivered, which typically is when the futures contract expires, right? So the idea is that if the futures contract expires, and let's say you're long oil futures, then you would essentially have 1,000 barrels of oil delivered to you when that oil futures contract expires. So for people who are actually in the physical markets of these things, and this is in the old days, mind you, no one does this now, but in the old days, the futures market was a place where people who grew, like farmers, could come and lock in a price today to deliver a set amount of, let's say, corn or whatever it is in 2 or 3 months time, right? So it helps the farmers not be entirely at the mercy of dealers who may well come and say, yeah, I like your corn, come harvest, I'll get X amount from you. And let's say come harvest, there is an overabundance of corn, right, during the harvest. Then the dealer is probably going to say, well, I know I promised that I'll buy your corn, but there's so many buyers now, I want a different deal. And that could leave the farmer entirely at the mercy of the dealer, because now they've harvested the corn. If they don't sell it, it's all going to go off. And if there's too much corn, then of course. So by agreeing a price today for the corn, whatever that price is, for delivery at on a specific day, well, that makes more sense for the farmer. And that's essentially what the futures contract is. It's, you know, to, in a way, protects the farmer from that kind of thing. But they also now become speculative, right? So people have worked out that if I buy this futures contract, right, by virtue of the number available, if I take up all the supply, then the price of the futures contract will go up. And we're going to talk about this a bit more, but that's one of the other beauties of futures contracts, is there's reported contracts volume, right? So you can see how many contracts are available, or at least how many contracts have been purchased. And I know we mentioned the central order book on the last, and we'll talk about more about this, but I believe we mentioned the central order book for futures, and that is something that you can actually have a look at and see how many contracts are traded back and forth. But we'll talk a little bit more about that in future slides. Now, I did mention cash settled, right? Because obviously some futures, like index futures, well, they can't really be delivered. Those are settled in cash, right? So it's the same for currencies. There are futures that are cash settled, right? So when they expire, as opposed to expecting delivery of let's say pork bellies or silver, you're just going to be settled for the value in cash, right? So basically it expires, it gets closed out, and futures contracts gets closed out, and then everyone who's up gets compensated, who's down obviously has to pay the compensation, and it's cash settled. Index futures, right? So these are contracts drawn against the stock index. For example, you hear people refer to the S&P 500 futures, or the smaller contract, which is also called the E-mini, or the even smaller contracts today, which is also called the E-micro. The E-micro is a new introduction to the CME. I can't quite remember when they brought that in, but E-micro futures are rather recent. I believe, if don't quote me on this, it was during COVID or slightly post-COVID that we saw S&P 500 E-micro futures. So again, and I could be wrong on this, right? And obviously do correct me, but it's very possible that E-micro futures did turn up a lot earlier before COVID. It might have been, again, it just, I can't recall, right? But the E-micros are also now part of the whole family of futures contracts. Commodity futures. These are drawn against commodities, right? Of course, this implies, right? So corn futures, crude oil futures, soybean futures. So these are all futures contracts that are related to commodities, which allow retail investors to have access to some of these things. And we're going to talk about this when we talk about practical, how we actually trade futures, when we come to using charts and stuff to do that. We are going to talk about how easy it is, right? Relative. Okay, let me not say easy, but it's much better. It's a much better entry level if you're starting to learn about futures to trade things like corn futures, wheat futures, soybean futures. And the reason for that is that whilst it's nice to have an underlying understanding of how these things work, right? Literally, it's all order flow. So you would literally see this on the order flow back and forth, right? So you can just trade it based on the order flow. So we're talking about the central order book. You can see how many contracts are being traded, and you can make your decisions based on the dynamic demand and supply picture. Of course, that being said, it makes sense to understand what makes corn futures tick, right? So what is it about corn? Do I need to know, for example, if there's going to be blight, disease affecting the corn? Is it that there's just going to be a slow harvest, right? So it's important to know that information. If you go to the CME website, there are a lot of links to like publications that publish all this information. Now, of course, things like corn and soybean tend to be rotated a lot in the US. So fields that are being sown with corn sometimes have the corn removed and then sown with soybeans. And this happens over specific cycles. And believe it or not, this stuff does tend to impact the price of corn, even if it's on a short term. I find that with longer term stuff, often you don't necessarily see too many, I should say, changes in the longer term cycle behavior. Every now and again, you might see a shift. And we're talking over 20, 30 years. And when you look at the charts that I'm going to show you, you'll be able to understand this better. Because like I said to you guys, I am someone who's all about proof. Right? So if I say something, I'm going to show you and I'm going to prove it to you. So I don't just blow smoke out of my ass. Right? So if you hear me talking about this stuff, you're going to be able to see it as well. Right? So corn futures. Right, so that's normally a good place to start is here, right? Because it's not particularly difficult to get to grips with what's going on here. Now, the other thing about agri-futures, as I call them collectively, is that they open and close at specific times. So they're still traded almost in the same way they were in the old days. So the big things tend to happen at 2:30 UK time, right? Because I'm in England, right? So the big things tend to happen, I think it's about 8:30 a.m. Chicago time. They tend to happen then. So what you want to do is you want to be available for these markets on the open, and then you can make decisions. And then usually the market tapers off. Now, most people don't tend to hold the contracts overnight because of overnight margins, and we'll talk about that. But commodity futures are actually a really good place for beginners or new people to get their feet wet, because also the margins are lower. That's the other thing. People don't think about this stuff, but the margins are lower, and it's definitely not the same margin requirement if you're trading, for example, the S&P 500 futures, or you're trading CL crude futures. Now, granted, some of you are going to say, well, they're crude micros, and there's also crude minis, so I can still trade crude. But when I show you the charts, like I said, I'll always show you, you will see how easy it is and how hard it is relatively to trade each of these individual futures, and it will go a long way with helping you decide through the stage of your journey what you actually want to trade. Because what you're going to find is, if you trade the wrong thing at the wrong part of your trading journey, you're going to start to find trading very difficult. And if you do, the likelihood you're going to continue with it might be very hard. The most resilient people are often the ones that stick with it, and you're going to start having an unnecessarily hard time. And I don't think that's fair if you're just starting out to give yourself an unnecessarily hard time. And I think we spoke about that when we covered stocks. It's as a beginner, if you wanted to trade, we wanted to get into investing and you were new, in my opinion, it's far easier to get into stocks. Now, there's a lot more to learn fundamentally about how the stock market works, and we have covered a lot of that information, all the relevant stuff. And like I said, in future lessons, when I do standalones, I'll talk about specific things, right? But we've covered a lot of that, and the reality of it all is that stocks are far easier to trade. And then next to that, if you wanted to get into futures, futures are incredibly difficult, in my opinion. They can be. So corn, agri futures in general, corn, wheat, soybeans, these are going to be the easiest to get involved in, right? And it will be a nice entry level to futures, as opposed to running after crude or the S&P 500 futures, which is where most people get driven into. And then we have currency and bond futures, right? So these two are kind of interlinked, as we saw with Forex. So I always talk about them collectively, but we've got bond futures, i.e. the 30-year T-bond, 10-year T-note, and, you know, so these are all tradable futures contracts. And then we have the currencies, cable, of course, euro futures, so pound futures is cable, euro futures, yen futures, peso futures. So these are all currency futures. You don't see a lot of trading around these, right? They're traded. Spreads a little bigger, right? So you don't. I think that you'll see as much as 4 pips on currency future spreads. So not as liquid as spot currencies. So if you're going to get into currencies, then you're better off trading CFDs. We've already done an entire lesson on Forex. But that said, you know, if you wanted to get into, you know, futures options, right? So options on futures, then, and you wanted to do currency, you've all heard of FX options, right? So those are options on futures. You could probably go down that route. You know, I've really enjoyed, as someone who's traded options as well extensively, I've really enjoyed putting on positions on FX options, and I've done pretty good on some of them. I wouldn't say, you know, it's stellar, but definitely done quite well on those. Futures options have a different kind of tempo to them, but we'll talk about this at a later stage. Right, so let's talk a little bit about some of the nuances that come with futures. So, and these are important, right? Because I want you to grasp these, because I decided to do them as nuances because they're kind of things you need to know if you're going to be a futures trader. And what I don't want any of you doing is getting taken by surprise, right? So there's something you didn't actually know and it pops up in a conversation around futures, and then it's panic. Like, oh my God, I didn't know that. I've done this massive course and I had no idea. Sorry guys, just having a sip of my Tereri. Right, so again, I wanted you guys to understand the nuances, like the words, the terms, what they mean, and how they're going to impact you. Some would impact you depending on what you trade, some won't. But we're going to talk about the whole shebang. Right, so futures nuances. So fractions and futures. Now, most futures are quoted in cents. So based on the days when it was fractional, so everything was quoted in eighths and quarters and halves, right? So these things were born around about then. So there's a lot of cent quoting, right? And when we talk about tick increments, and I will send you guys to the CME website to look at contract spec for these things, right? Because like a lot of futures tick in quarter increments. So each tick is going to be essentially worth $12.50 per tick, right? Regardless of the future you're trading, you're going to see that they're all roughly about $12.50 per tick, $50 per point. So for example, if something moves from 301 to 302, that's 1 point. And inside of that point, it's $50 per contract, right? So that's what you make every time you get a 1 point tick. So if oil ticks 4 or 5 points in a day, which is kind of usually the max sort of movement, I say oil, corn ticks 4 or 5 points a day, which is kind of the maximum movement we see in corn, then that's about $200 to $300, but $200, $250, $300, whatever, per contract. Right, so if you're trading 2 or 3 contracts of these things, which you can easily do, because the margin's are a little bit lower, then, and as a beginner, I mean, because I won't start out with 10 contracts, pardon me, as a beginner, that would be too much. But if you can do that, then it's quite a bit of bob. You know, when you're looking at 200, let's say if you cut it in half, well, you know, $150 to $200 per contract a day. Well, you know, three contracts could easily be anywhere from $450 to over $500, and plus, you know, or even $800 at the max side, per day, right? For some people, that will be decent money, and you wouldn't have had to put up a lot of margin for it, and maybe on a risk reward basis, you're out for a point, or let's say even 2 points, right? So you could potentially lose about $100 a day with a view that you can make anywhere to up to 400 to 800, right? And that's if we're looking at an asymmetric sort of model. So yeah, as you can see, it can be quite lucrative, and when I show you the charts, you'll see that. But a lot of it is priced in cents, right? So fractions and futures. So we talk a lot about cents. So when you look at a ticker, you'd normally see them like this. Essentially what that means, it's 300.25 is 300 cents, so it's $3.25, right? So that's kind of how we look at it. But we'll talk about all this stuff as we go. Spot versus futures price. So when we think about the spot price and the futures price, a lot of people don't know. So when we say something is a spot price, it's what it's trading for now on the spot. Normally we describe spot as a 2-day delivery. So if you are dealing with a physical thing, it will normally be delivered within 2 days. That is considered spot, right? So the spot price is the price today. There's normally a difference between a spot and a futures price naturally. Whilst I might be bullish on the asset in the future, and that's going to mean the futures price is going to be a little bit higher than the spot, essentially we call this difference basis, right? So there is a difference. So the futures will be higher, it could be lower. If I'm bullish today versus that, we'll talk about what that actually means when the spot is higher than the futures or the futures is higher than the spot. Right, so we call the difference though between the two bases, right? So that is a term you'll hear used from time to time, basis. If you don't hear it, you never have to use it, great. But it's important to know the difference between the future and spot, and you will soon see why. Contract spread and contract roll. Now, depending on the delivery month, futures contracts are often priced differently. For example, January oil priced at $80, or rather can be priced at $80, but February oil can be priced at $85, right? So there's a 5-point basis, right? Now contracts are typically rolled 8 calendar days before expiry, right? So typically we're going to roll those contracts, and when we say roll, we mean that we're going to move them to the next contract month. So I mentioned, for example, January oil is priced at 80 and February oil at 85. If we're in a January oil contract, before the contract expires, if we want to keep holding it, we have to roll it into February. Because remember, if the January or contract expires, then we will have to take delivery for the 1,000 barrels of oil at $80, right? Since we don't want to take delivery of oil at $80, right? We should cancel that contract or roll it and then take out a new one for February at $85, right? Which is where it's trading, right? So there's a 5-point basis between the January contracts and the February contract. I shouldn't really say basis, because we're talking here the difference between contracts as opposed to spot and futures. But this is more like a spread, right? So it's a contract spread. So I used the wrong word there. But January oil priced at 80, but February oil's at 85. There's a 5-point spread, contract spread. So again, as long as we roll those contracts 8 days before and move into the new one, we should be fine. So this is something you hear a lot about. So either you hear traders talking about spread trading, so they trade the difference between different contracts, contract spreads, or you're going to hear people talking about rolling a contract. So this is also common in the options market. You'll hear them say, I rolled my options. Well, essentially they're doing the same thing, taking an option that they hold today, and it's usually option sellers tend to roll a lot more as opposed to option buyers. So sellers of option contracts will often roll in order to collect more credit and stay in the game till, and we'll talk about that when we get to options. I don't want to get ahead of myself, so I'm just using these words, and if you don't understand them, don't worry, I will come back and address them again. And the other thing you'll hear a lot with futures, typically with oil, I hear this a lot more with oil than anything else, is backwardation and contango. So backwardation is when the futures price is behind the spot price. So going back to this spot and futures and basis, if the futures price is behind the spot price, right? So you got a futures price, let's say $20, and the spot price is say at $30, then the futures price is behind the spot price, and that's backwardation. Now, if you think about it, why would the futures price be cheaper than the spot price? It means that in the future, people expect the particular commodity to be much lower in price, and that's already priced in into that contract, right? Because remember, the dealer in the old days will be paying the price now for delivering the future, so they have to compensate for the fact for what they think the future will be. So if they think that the future is going to be more expensive, then they're more inclined to pay more today, right? Because they think, oh, well, it's going to be expensive, right? So it's going to be more than it is today, so well, I've got nothing to lose by paying this person this amount of money. So usually there's a lot of understanding of what the futures price is, and hence why there's a difference. So this is what we call backwardation, right? The opposite is contango, i.e., if something is contango, it's the what we get is the futures price is ahead of the spot price, or the spot price is behind the futures price, right? And that's what we call contango, right? So usually this leads to what we call roll yield, right? So if the spot price is, let's say the spot price is behind the futures price, then you get less. So you get negative roll yield. You get less for rolling your contracts because the spot price is essentially cheaper. However, if the spot price is behind the futures, then you'll end up with positive roll yield. So it kind of just works that way. But it's not incredibly important, because most people are unlikely to be rolling their futures contracts. What tends to happen is that you trade the futures contracts up until that 8 calendar days, and you just get out of it and it's done, and then you move into trading another one. So it's not incredibly important, but it's important to know. So if you want to kind of dig a little deeper into backwardation and contango and all the cool stuff that comes with it, then this is going to be an area of research for you, right? This is not something that we should teach you in a classroom. It's just an area of research, and then you can formulate ideas and theories around that. So it's part of that process of becoming a mature trader, is understanding these things and seeing if it fits into what you're doing. Because a lot of people, they learn a lot of stuff, right? They might, know a lot of things, but it doesn't necessarily fit in with what they're doing. It's not necessary, but they know it. And maybe in the future something happens where you're like, oh, I've got this great idea, and you only got the great idea because you actually know what backwardation and contango is. So it's really important to learn. And it's so disheartening sometimes when you run into a trader. It's like, I don't want to learn all of this, just give me a playbook. And you're like, Jesus Christ. It's no surprise, right? Sorry for the blasphemy, for anyone who's a Christian that I've offended. But look at it this way, guys. It's not a surprise that so many people lose so much money in this business, and they just keep losing and they wonder why. It's because you're unwilling. You are unwilling to learn. You don't want to know. You want a shortcut. You want a quick fix. And there's no shortcuts or quick fix. Knowing some of this stuff could be massively, massively beneficial. If I take myself as an example, in my early days or slightly earlier days of investing, like most people, because I was also in the institutional space as well, very early on, people are doing specific things, and there's the temptation to be looking, oh, that guy's doing this, and I'm just going to do that too, right? There's that temptation. But then again, you have to consider that actually, what is it I don't know that could give me my own edge? Anyway, to continue with the story. I wasn't so keen on options trading, right? That wasn't my forte. And I was like, nah, I'm not interested in that. You guys do your thing. Well, down the line, a little bit down the line, I discovered, oh, great, options, amazing, right? What they can do. And that already came from actually learning and understanding them. And that allowed me to formulate a strategy of how I wanted to participate in options, right? So I didn't end up doing what the vast majority of people ended up doing. I ended up doing something entirely different, maybe not unique, but different. And I was able to put that to work and essentially benefit myself massively, right? And that's where I want all of you guys to be, so you can look at an opportunity. Maybe it's something I don't even do, but I've given you the groundwork and the direction so that you can go out and explore that further. Okay, so let's talk about margin variation. So, margins are the beating heart if you're trading futures on an exchange. I'm not talking about that CFD stuff now for futures, which in my opinion I wouldn't touch with a barge pole, right? But if you're trading in a proper exchange and you wanted to trade futures, you wanted to be a futures trader, you're going to have to understand margins. Now, margins in brokers that offer futures, they can vary. In a way, it reminds you of something like, if you ever been in a Bitcoin exchange or something and something goes loopy and those margin requirements might explode. Right, so generally all the derivatives, whether it's futures or it's options, they're subject to margin. Now some brokers will use what's called span margin. I won't get into that. It's a little bit more complex, and if you want to reach out span margin, you can do that. But some brokers will use that, and other brokers will use other kind of margin requirements, right? And sometimes margins can be higher than others, and you'd often see people use that as a way to entice people into them. So some brokers will tell you our margins are quite low. I, for example, had that experience when I was looking at tasty trades. I've got interactive brokers, so I don't really need anything else. But I was also looking at tasty trades, and I noticed that if you're an option seller, then it might be advantageous for you to have a tasty account because their margins were lower. So it allowed you to get into options for, by my estimation, at least 20 or 30% cheaper in terms of margin requirement than if you were, say, with some other broker. Right, and that was just my experience, right? And I'm not affiliated with Tasty. Everyone knows Tom Sosnoff. He's quite an authority in the option space, has done some incredible work around options in educating the public and everybody else. So You know, he's a legend in the industry, right? So it is what it is, but I've got nothing to do with them, not affiliated with them or anything. It's just I felt the need to mention that story because it's something you'd see. Some brokers can offer you lower margins, some can't, right? And they all have their reasons as to why they can and can't. And also the thing you're going to find is that this margin can change depending on volatility and other factors. Right? Overnight margin, so if you want to hold your futures contracts, let's say for example overnight, it's going to cost you more. And that means that often most people end up trading regular trading hours where the margins are lower, and we call this RTH margin. So a lot of people are going to be doing that, right? So you've got to be aware of the variation aspect of margins. Hence why I say as a beginner, you start with the agri futures, you tend to not see as much margin variation other than, like, say something like the S&P 500. If I recall, pre-COVID, to open one S&P 500 contract was about $2,000-$3,000 in margin. Now, I know, guys, you're going to tell me, I know this discount broker and they're doing like $500 in margin, right? That's fine. That's great. You know, this is what I mean. There are people who are going to offer you lower margins, right? But I don't mind the higher margins where I am, but I'm just saying that you are going to see those variations, and I'm giving you an example based on those variations, right? Now, you'd see $2,000, $3,000 in margin pre-COVID, and then COVID happened, and then we got all this volatility in the S&P 500, and then you started to see margins go up. And you're going to see when we come to the charts why you don't want to ignore this stuff, because there's gap risk overnight, and we're going to see some examples of what that could look like and how that could destroy traders. So it's all good having low margins, but on the same token, you could still get blown out of the water anyway. Right, but margins, I believe, went up to about $8,000 for one S&P 500 contract post-COVID. So it can really go up. The other thing that was cheaper on margins was bond futures. You know, you could trade bond futures contracts at the time, you know, sort of the earlier part of COVID, if I recall, or pre-COVID, was about $900 per contract. Right. I think those contracts jumped to about something like $3,000 per contract. So the thing, bottom line is that they move around. So just watch that. And the other thing is the order book and the market profile. Now you're going to find two types of traders, right? You're going to see this from the outset. And the reason I've got lots of content on order book, right, on the YouTube page. Just have a look on some of the stuff I did on order flow. I'm going to probably do a lot more on that, but I've got a lot of content, and I have dedicated course programs on Udemy, you know, which I'll probably start linking to some of this stuff at a later point. But I've got a lot of content on order book and market profile. But you're going to get two types of traders, especially when you're talking about futures. You're going to get the guys who are the order book guys. So if you already look online, like the guys who really think they're smart, they've already started to put a lot of content online about order book, right? So you're going to see a couple of terms associated with this. Footprint charts, which is another representation of the order book, right? So you're going to hear a lot of people talk about footprint charts, and you're not going to hear a lot of people talk about dome or ladder. Right, so depth of market ladder, right, level 2 order flow. So all of these are associated with the order book. Now the order book, in my opinion, is only useful to people who trade short term or intraday. It has little to no use for people who trade longer term. So this drives the remainder of the market into what we call market profile. Now people prefer it because it allows you to see standard deviations, right? Because there's an option market, at least this is my opinion, someone can tell me if I'm wrong or they have a different idea, but because there is an options market, prices of these things tend to get restricted by people selling options at the outlier deviations and people buying options in the opposite direction and so on, and also selling and so on. So the extremes tend to they tend to cap the asset. Occasionally you get a breakout. So people who are market profile traders will be looking for those outlier extremes. And like I said, I've got a dedicated program to this, but I will touch on market profile as part of the lesson set up again at some future point, but we'll talk about that. So you'll see some of the smart guys, one of the bigger platforms that provide some really good at a reasonable price, because trust me, platforms at this level where you're looking at order book and market profile start to get pretty pricey. Most retail traders, I'm not saying everyone, okay, I know some of you guys have got a bit of money as well, and you're going to be able to play with this stuff even though you're retail traders, right? But I'm talking about the vast majority of people who are new to this. They're not going to be able to do that. So their focus is going to be largely on accessibility, right, with their funds. So you're going to see a lot of these guys pushed into spot markets, and they're going to trade Forex, they're going to trade CFDs of indices and so on. So that's where their business is going to be. And for that reason, a lot of them are not going to have access to the platforms that can provide you with order book and market profile. But making the assumption that you can afford to do all of this, because it's costly. Like, you know, just to give you an example, if you wanted to get a dome, depending on who you're with, this could set you back anything from, depending on how you do your exchange pricing, anything from $15 to $50 a month, right? You know, that is just the way it is. It is just the way it is. So if you want level 2, you got to pay exchange fees to get level 2 order flow. And then if you want, so again, sorry, I nearly digressed there. But if you wanted to get hold of the order book, you're going to spend money. So there are different types of traders, right? So you got the order book guys, and then you got the guys who are going to go with market profile because they prefer to have a longer term view. You know, I've got a podcast. I did an interview with Stephen Hawkins. It's a good chat. Really amazing guy, but he's one of the founders of Market Profile, right? So along with Peter Steelmeyer, you know, that is just the way it is, right? So we spoke a lot about Market Profile, and because these guys are largely swing traders and they got massive positions in the futures markets, they prefer to use Market Profile, right? So Market Profile is going to become that dominant thing when retail figures out that they're being crushed everywhere because they don't have the right tools. You're going to start seeing more and more videos by more and more famous influencers come up around Market Profile. What I find is that you don't see influencers with Market Profile a lot. So when you go online or you're looking at what's out there for education at the moment, you don't really see Market Profile. Or what you'll see is volume profile, which is easy to put on a chart. And you see this a lot on social media, Twitter, people posting volume profile charts, which is really just the composite volume. But you'll see it a lot, and people attempt to trade against that. In my opinion, there's not a lot of information, but it's popular because it's kind of easy to read and set up. You don't need to learn anything. You know, whilst if you wanted to really understand the concepts of market profile, it's, you know, the CME had a 375-page handbook. So most people would avoid this, but the top players will look into this, right? So most futures traders try to understand how orders are placed in the central order book. So they're going to be order book traders, and that means that they trade more short term. And then you got to get others who use market profile to observe moves around fair value within a given trading period, right? And these guys are going to be more swing. So when I've always taught or educated around this business, I would teach people both, right? So they have an idea that exists, and if you want to be more of a short-term trader, then you can go spend a lot more time trading the order book. And if you wanted to be a swing trader and you wanted to get, you know, you wanted to really get a good representation of what the market is doing over sort of a medium to long term, or even on an intraday basis, but really looking at the individual day profiles, then market profile will be where you'd want to go, right? So I would normally advocate people spend a lot more time with market profile than they do with the order book. But again, you can't stop people going into the order book, because when you get into the order book, guys, no one can teach you anything. Like, I've got a lot of programs on the order book where, you know, you observe certain behavior and you can say, well, look, this is what this looks like, right? So if you see it, it's more than likely it. But you don't know for sure, because the truth is, I think about 60-70% of the market is algorithms, right? And these algorithms are behaving similar. So you might see something that looks a little bit sinister, but probably it's not, right? So there's a lot of subjectivity when you're in the central order book. But again, if you're intraday trading, what you will be able to see in the order book is big orders. When things drop and it gets heavy and there's a reaction, you can sort of see that on the order book and then look at maybe a basic candlestick chart or something that will kind of give you an idea, or a footprint chart, right? So again, order book guys tend to be guys that are sort of day traders, and people argue that, well, if maybe I'm not so much that, I'm kind of in middle, then you see a lot more people gravitate to footprint charts, which is just kind of a more static version of the order book. Anyway, I spend a lot of time talking about order book and market profile because they're such big topics and they so govern the way people come into futures that often traders who are not doing these two things are normally having a hard time. I'm hoping through this thing I'm going to be able to show you a way to trade futures without necessarily gravitating hugely to order book or market profile if you're just a newbie or beginner and you just don't know anything, right? It'd be a good place to start, and then you can expand your knowledge afterwards. Contract spread. So again, I've just repeated these actually. It was margin variation order book I largely wanted to speak about. Right, so I'll skip. Messed up this slide, guys, sorry. So let's talk about how to trade futures. So we're going to go by steps, as I always do when I'm showing you guys this stuff, is I go in steps. So step 1, I tell you what to do. Step 2, I tell you what to do. Step 3, I tell you what to do. So this is the steps you'll follow from an observation to execution perspective, and I'm going to show you on a live chart what that looks like, right? So we can have more or less a full picture. So we're going to go through that now, but before we do that, whilst we kind of stew on this, let's take a short coffee break and then we come back. Okay, so back from the coffee break. Hope you enjoyed it. Okay, so step 1, right? So the first thing we want to do, so we're learning to trade futures, and I'm going to show you guys, like I said, on an actual chart so you can actually see. So go to a TradingView chart or provider that will allow you to view a continuous contract chart. So by that I mean you need to go to someone that's not going to show you the individual contracts separately, so you're not going to see the contract codes. What you're going to see is a continuous contract, right? And I know TradingView does that, so I'm sending you there. So you want to get the continuous contract, and you want to look at the monthly chart so you can use the concepts we've just discussed to essentially figure out what your bias is. That's the first step. You want to develop your bias. Now step 2, you want to drop to a daily chart to look at volume rotations. Now we did something like this very similar in Forex. We did the same thing in stocks, so you want to figure out what your volume rotation is. Now hopefully, as you guys have been noticing, stocks and futures are very similar in terms of how you go do the steps. And if you looked at the way we looked at Forex, you would have noticed very, very quickly that it was actually really hard because we had to go down. So we didn't necessarily look at the monthly charts. Well, we kind of did. We did a little bit. But again, when we started to come down, we ended up having to come down to, quite a few, minuscule time frames to start doing the business. So if you notice with futures, you can really take your time with it and come down and look at maybe, say, a daily chart for execution, or you can do similar with the stock market without needing to intraday trade. So you start to see these little nuances develop, and you'll observe them yourself, right? So again, drop to the daily chart and look for high volume rotations. Commodities have a lot of gap risk, and I'll show you what that is on a chart. So again, we spoke briefly about understanding your specialist market. So I told you, go to the CME, take a look at what the contract specifications are, and really build knowledge around your asset class. Step 3, remember to consider where you are in the daily move. Are we at the bottom of the chart? Are we at the top of the chart? Right. So these are the 3-step approach you're going to take, and you're always going to be looking for the things that we spoke about in previous lessons, where the stops are going to be, liquidity hunts. These are going to be the same idea from asset class to asset class, because for as long as there are things like stop losses, stop orders, and there is generally somewhat of an order book where orders get placed, that behavior is not going to change. Now we know that because the only way to get into the most efficient price, the broker has to take out the stops. Right? That's how they can offer the best price to, say, the bigger traders. And you're going to see in a chart what I mean by that if you haven't really grasped that from prior lessons. If if someone wants to buy something dead cheap, someone has to be willing to sell. Now, maybe you don't have the guts to click the buy and sell button or the sell button at a certain price. Maybe you think it's a little bit low, but the one thing I guarantee you're going to have there, if you're in a long position, is a stop loss, right? So you're going to put your stop loss in a place where you're going to think, oh shit, if this market goes against me, this is going to be a breakout move and I'm going to get stopped. So you're going to put your stop beneath lows, significant highs, and no one can avoid this. And that's because we need to assess risks. The further the market moves away from our entry price in the wrong direction, the worse it is for us. So we have to make that decision early, and we need reference points. And because those reference points are always going to be the same, largely, they're not going to change. I mean, there's only so much, there's so many places you can put a stop loss between 1 and 100, right? So you're not the market is the same all the time. It's just the psychology of it that we keep getting wrong. So largely, if you know that there are going to be a ton of, let's say, and I'll show this on the chart, it'll be easy to visualize, but let's say there are a ton of orders underneath a significant low. The vast majority of those orders are going to be sell orders, right? Even though it's below a significant low, right? Which means the market's probably run away anyway. Orders have no business being there. But people who are in a long position, right, or just too early in that long position, they're going to have orders there. It's unavoidable. Right, they're going to have orders lower down the order book, right? So if they're in buy position, they got to have orders, sell stop orders or sell stop loss orders lower down the central order book, right? And their breakout traders are also going to have sell stop orders to trigger them in, and also at levels that are going to be considered to be breakout levels. So there's going to be an overabundance of sell stops at the bottom of the market. So if the market wanted to cheat the most traders, right, and I use the word cheat just so it makes sense to everyone, if they wanted to cheat the most traders, then they will go to those sell stops and fill them all, because those are going to be translating to long positions, people wanting to sell to other people who want to buy. So the people who are going to buy those sell stops, they're going to be the people who maybe they have insider information, I don't know, but these are going to be the smartest people, right? And their orders are going to get filled there, and that's why the market is going to go higher. It's a bit reverse psychology when I explain it to you, is that all of a sudden all these abundance of sell orders at the bottom, but then the market goes higher. How come? Well, that's it, because to every sell order there must be a buy order. So if all those sell orders got filled, then it makes sense that there have been an overwhelming number of buyers. And again, if those sell orders didn't get filled all in their entirety, then there's still an overwhelming number of sellers, and then the market will go down. And that's why from time to time it won't always work, but there's a higher probability that it would work, right? So if we already know that, then we know that this is going to be the same for every market. It's going to be entirely irrelevant what market you're in. You're going to see the same thing over and over again with a few nuances, right? And that's why we covered nuances in the beginning, so you can understand, okay, some of these factors are going to, you're going to see behavioral change, which is going to violate some what I'm telling you, some of it anyway, but it won't matter because you already know that, right? And that's the point of telling you. Anyway, let's press on. All right, so we're going to take the first proof, right? Like for me, I'm big on proving things. It's really important. So here we're looking at corn futures. Now, the first thing I want to do is develop a bias. Now, the thing we're going to notice is that these are like 30-year cycles in corn. So corn tends to be at a high price and then trade across like 30-year cycles where it's just looking bearish, and then it hits a bottom and then goes again, and then we might see another 20-year cycle, and then we do a high, and then this hasn't changed, right? This has been going on since the 1970s, right? I wasn't even born then. That's how long it's been going on. I didn't even exist. I wasn't even an embryo, right? I wasn't even a, you know, yeah, arguably some people will say like, well, yeah, my mother was alive, and, you know, women are born with all their eggs. So I was technically, you know, I was an egg waiting to be fertilized, put it that way, right? But I was nowhere near that, you know, and somewhere in the world there was, you know, there was a sperm that was going to make me, right? Whatever. But the point I'm trying to make is that we are going to see this over and over again because it's been happening in some cases longer than some of us have been alive. Now, of course, some of you guys in your 50s, you were a bit of a tiny tot in the 1970s, but, you know, it is what it is, right? This has been going on for a while. So look, reality is that we want to look at these significant lows. Here we have the low just prior to 1978, and then you can see the market traded. We got the high, which was just after 1974, and then we have this period here where we got a high and low. So this is the high of week prices at 397 cents. We spoke about these being priced in cents, so you can see that on the scale. 397.50. Right, so that's $3.97. That's kind of what it's priced at the moment. And this, obviously, the 0.5 will be and a half, so it'll be fractional. So we're not going to worry about that as much. We already know that corn ticks in quarter increments, so we kind of already expect that, right? So we're not going to go into that now. Right, so the bottom line, we can see a high, we can see a low. Then all of a sudden, just post 1986, we put in a low, and then we recovered, right, just above the prior low, right? So we can clearly see that was a liquidity hunt. We spoke about this concept before, right? So that was a liquidity hunt, which means our bias for corn has to be bullish in the long term, right, to go over the liquidity high, which was 397, right? We posted a liquidity low near the 145, and then we covered just above 181. Then this corn becomes a good investment, right? And again, why, you know, why, I mean, if you ask yourself, why would I invest in corn? Well, they're corn ETFs, right? These are in the stock market. So you can buy a corn ETF if you're betting that there's going to be inflation over that period, right? And the liquidity hunt tells us that there's going to be inflation because corn prices are going to go higher. And as a result, we're going to get inflation. Okay, so I think we get a lot of the points. So you're going to find that there's a lot of ways to invest in corn. So if you're going to do that, you can buy a corn ETF, for example, and you would have think of this that you've capitalized on inflation. And what that essentially means is that as prices of corn rose, ultimately your portfolio will rise as well. So corn, in my opinion, if you're going to do stuff like that, you're kind of doing an inflation trade. And obviously, as you can see in the 1980s, as we thought, inflation was remarkably, was very, very high. And that persisted to a large extent, you know, even into the sort of just pre the mid 90s. And then we had a huge spike post 1994, where we had some of the highest prices in corn. And as you can see, we had a massive liquidity hunt here. You can see that where we went above the highs, took out the liquidity, came back down under 397.50. So under $3.97. And then we came all the way down and then took out the liquidity down here, which was, you know, sort of into 1999. So you can start to make some intelligent, you know, predictions as to, based on what we're going to see with inflation, whether corn prices are going to go higher, whether they're going to go lower. So again, we can see into the dot-com boom, You know, we see corn prices rose, and that was in line with the dollar. Obviously, the dollar declining, and a lot of people investing in commodities as opposed to the US dollar. Right, so you can see these cycles, and as you can see, they're over long, you know, we're talking 2 decades at minimum. Monetary policy over a decade impacting these commodities, right? So having that bias is kind of crucial. So even when we get some of the short-term price action, so it's clear that we've taken liquidity here, so the next move has to be higher. But you can see somewhere between sort of the late 90s and the mid 2000s, these prices were rather subdued, right? So we had a lot of range trading. And, you know, again, you can see the short-term liquidity being taken out or return under. And that does present, since we're looking at a monthly chart, that does present some pretty good, you know, sort of intraday, midterm type trades. But in reality, what we should have been using this period for is, rather than playing the short side, we should have been looking for opportunities to improve the long side. So whenever we saw a liquidity hunt, for example, we saw one in the mid 2000s. Well, actually, no, we saw this more towards pre-2006. Yeah, so mid 2000s, you know, and that was more evident in 2006. And that led to one of the biggest rises in corn. So again, if you were buying these as a long-term investment, so let's say you were active in an ETF, for example, like CORN, then that would have been a pretty decent investment in line with corn prices, because we had a really big spike, right? And then we kind of had that new high because we took out the liquidity here, higher corn prices, and then we declined. So again, we can see that once we saw, you know, $7.76 or 776 cents posted, it should have become clear that will be the next liquidity hunt. So if you ever saw corn prices go back there, you wanted to be sure. And even though we had a bit of a short term, you know, where things looked unsure, I mean, we could have even gone to, you know, $9, right? But that's the point. You should have been more or less prepared for what you're seeing, right? Because you know that if you're going, you should have quite a wide berth up to $10 if need be. One that, you know, that's where you should have been from a risk analysis standpoint. And obviously, as you can see, we traded right down, and we can expect that we were going to trade just under $3.17, which will become the new liquidity low, right? We can see that. Now, of course, there is a chance that we can come back down to these lows. But historically, you can see that corn prices have been rising from the lows. So the lows have been getting tighter and tighter and tighter. So even if we do come down, this for me, under $3 becomes the new area to watch. And that's where I think we're going to go on this cycle, right? Because as you can see, normally the declines are quite aggressive. And the likelihood of us pushing new high prices now is very slim. We haven't seen you know, corn prices going in in this sort of linear fashion to the upside. It's been very range bound, and that's what we expect, right? We can see that. So for me, I mean, if we start posting lows here and recovering, taking out liquidity, then that will be interesting to me. So it gives me a bias. So I'm short biased in that I'm expecting corn prices to go much lower. But in the short term, they could still trade within this range, right? So if we do see the price going up, we're not necessarily wrong. We could just see short side liquidity. And if we have a bearish bias, we can just wait to trade that short side liquidity. Maybe we go look for something else to trade in. If we're not an intraday player and we really want to be looking at this to develop bias, then, or we want to take trades off this that are going to be more long term, then maybe we should just go look for something else. But again, we understand that when we see the short side on the longer time frame, that's when we want to really get excited. Right, so let's take a look at another example. All right, so here we've got corn futures. So this is reflecting the next portion of our steps. So once we've developed our bias, let's say we want to sort of trade a little bit more closer to the market, I like to say, so you don't want to be sort of out doing monthly charts, but you've got your bias and you kind of know what you want to do, and you want to trade this more as a swing play. So here's where the understanding of volume comes in, and we covered this before. So really what you're looking at here is just a repeat, and again, it's just me proving to you that everything's the same. So let's look at a couple of things. First thing we're going to talk about is the gap risk. So I said to you before in the lesson, if you recall, commodities have gap risk, which means that you could be sitting on something, it gaps several points, and then you're blown, basically. So here you can see corn prices, you know, they're marked on the chart 20 points at a time, right? So you can imagine, like, waking up in the morning and corn here has gapped 20 points, $50 a point. Right, think about this for a second. It's $1,000 gap, right, on one contract. And this happened in the space of a day, right? So there's gap risk in commodities, which is why people don't like to hold them overnight. We spoke about overnight margins. They're expensive for this reason. Because if you woke up in the morning and there was massive gap risks, you don't know if that gap's going to get filled. As you can see here, that gap didn't get filled. I mean, it pulled back by maybe 500, so it allowed you to have a smaller loss because there's 20 points in here. So you had a 20-point loss per contract, $50 a point. You're getting the gist, right? 20 points is what it is, $1,000 for every 20 points. So you got a $2,000 gap here. We recovered 1,000. So yeah, it's not good. Here, because this entire gap was 40 points, right? Here you see something similar. This is roughly about 25-point gap. It did get filled, so you would have survived if you were in a long position and this thing gapped under you. Right, so this is the problem we have here, is gap risk, right? So it's always something to watch out for. But let's say that you're in a position to deal with the gap risk, because I'm showing you this so you know the inherent risks. There's so many people saying they're showing people how to trade and invest, and they're not showing them the risks. What are the risk points on the chart? And I'm not talking about the risk of losing on a trade. I'm talking about the risk on the board, the overall chart. What could happen that is going to be more than you could afford to lose, right? This is the point. So again, if you're looking at it this way, you can see corners gapped twice between April and June, right? So, no, point in case, right? But what are we looking for when we talk about float rotate? So generally, we will have an idea of what average volume is and what high volume is, and we're always looking at that relative. What do I mean? If I see a volume spike here, and then for the next couple of days, volume is under this, it's low. And then all of a sudden, I see a volume spike like this, then it's comparative, right? I've got higher volume than prior. It was dropping before, and I can see at what point the volume is more significant, right? So I can see that here. And that gives me an idea of what's going on. Let's look at a few examples. So here the market declines, and then we posted massive volume. We can see historically, and this is above average, right? And it's happening on this day. Immediately we think, well, someone's jumping in here to buy. That means that there's probably going to be a degree of a liquidity hunt, which is what we get in the following day. So in effect, what we're always looking for, especially when we're trading commodities, is big spike, slight recovery, a trade under, and then a recovery. Right, so it's the same thing we've been talking about over and over again. Market basis stops up here, takes that stop, and this is what we call it. It's hunted liquidity, or it's moved lower to grab some additional liquidity. The bigger players need this so they can buy all they can buy at the cheapest possible price, and then we get a rally. So you can see here now, huge volume, dip below, even higher volume, which signifies that liquidity hunt, and then a climb above. So your entry starts to be round about here, just as we get above this line, right? And then we're sitting solid. So now we want to be long. We can also see here, middle of the way, strong bull candle, high volume, right? We consolidate, right? So we see that here, and then we want to mark that level, right? So we're saying, well, we've closed above the main volume. It's a good entry with stops just below this bar here. This will be a good bar for benchmark, right? It's because it's the bar that closed above the main volume bar. So this is what we talk about when we say nuances. This is an idea, right? This is an idea that I've cultivated over time of years of observing, right? So now I've got this understanding. This is something that it's hard to teach. I've been watching these things, and you just know somewhere down the line that actually every time we get a huge volume spike and we get a candle that closes, where we get a closing price above the high of that bar that has a massive volume, then we tend to get continuation. Even if prices go down a little bit, whatever, we get continuation. So you're used to seeing that. After a while, it's not always going to hold true, but then you start to build a model, right? You start to build something that you can understand and you can then act on when you see it, right? And the fact that you have a longer time frame that you're looking at, which is a daily, you have a lot more time to adjust to that information, right? And then make a decision. So you can see here that our initial entry came when just after the liquidity push. We start to rally, and also we know, talking about where we are on the chart, you can see that this is the top, this is the bottom. So this was likely buyers, in all fairness, right? Here you can see they were, again, they're more than likely buyers, even though we had a breakout, right? Which is going to trigger a lot of people trying to sell and get trapped ultimately, right? And we can see that when that volume comes in, is there was an overabundance of sellers. So the buyers were able to find people to do business with, and that pushed us up, right? And that's where our entry comes, right? So people give this stuff all kinds of names. We trade against retail, we do this, we do that. They're going to make themselves, look big, and knowledgeable and savvy. But the truth is, market just found liquidity and it's reversed, and it's a good entry point. And we don't have to gloat about it too much, but that's our trade. That's where we want to be in. Right? And then once you're in, right? You could be wrong as well. We could come down, do another liquidity spike. And if you recall, I said to you that will always work that way, is because if I'm a buyer here and I'm long, I'm going to put a sell stop at the bottom of this low. I mean, where else am I going to put it? I want to minimize my risk, right? I'm trading commodities. Where there's a potential for a 40-point gap, I want to minimize my risk just in case I could get filled before this market gaps under. It's not likely, but let's say I did. I mean, if we look at it, it's a 20-point risk, right? If I'm getting long here, I'm looking at about, maybe give or take to the low, about a 25-point risk, right, on a daily. So again, $50 a point per contract. 25-point risk. You can do the maths, right? So if I'm going to sit here, then I sure as hell, I don't want to lose more than I'm supposed to. So I'm going to have my stops maybe at 540, right? So the market could come down and say, oh, great, another bunch of stops. Haha, take them all out and then go higher, right? So I'm not always going to be right with the entry, but I'm working on the principle. There are a few things I can see. I've got very high volume, right? The gap's already happened, right? And we can understand that, okay, well, a lot of people will probably be liquidating as well because they were long. Their stops are going to start getting triggered, right? Or they're just going to be like, oh, damn, I messed up, I'm getting out. So they're going to sell as soon as they can. So there's a lot of confusion. It makes sense. I can see that with the volume. There's a lot of people scared because we just had this gap. They're out of the, they're down almost 40 points. By the time we started to touch out here, it was 40 points. And then they're down another 60 points. I mean, gee, and then now they're down about 65 points. You really think they're holding on? Remember, this was overnight risk. So their immediate reaction is sell, and then the buyers step up. Some of them are going to be market makers, right? They put these people in a very awkward position, right? Gap the market lower. Could be a conspiracy. I'm not saying it is, but it could be, right? It could be the big players in the core market getting together to corner these guys, right? We don't know. That's the truth. We do not know. But what we do know is, regardless of whatever was planned here, the fact that this market is doing this is indication that people are taking the bait. They're selling. And if they're selling, you got to ask yourself, who are they selling to? It's obviously not me, right? Because if you're in that position as those guys, they're obviously not selling a year. So who are they selling to becomes the question. So we go higher, right? So as those stops trigger, right, those sell stops trigger, buyers step in. Largely the market makers buying cheap. They've stressed everybody else out here who thought that it was going to go from here. Now they're all selling. And the market goes, and it goes straight past this level. So they're all sold in a panic after they've been crushed for nearly 65 points in the space of a couple of days. They still managed to run this price to just over 660, right? Think about it, guys. Now, for obviously, again, for good reason, anybody who was long here and, you know, they stayed the course and they got here, their first reaction was, ooh, sell, 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 I'm getting out. And, you know, I was long, I'm just going to get out for break even. This was the worst ride of my life. I'm glad. But clearly, this is a saving grace situation. Right? So if you were long here and you had an additional ad here, then you're going to sell. And why are we going to sell? Because you can see the high volume crept in, right? Right, we can see here that high volume had already started to step in at this point. So this just was a short squeeze, right? So this could be a combination of people selling or effectively shorts coming in with the view this is going to go down. It's a short squeeze and it went even higher, right? But if you're long here, there's no point selling here. You've got protection here. Just stay with it. You never know. If we do break down and trigger your protection, that's great. That's okay. Just break even your entry trade and then wait. Maybe if we trade back down here, that's the beauty about commodities. We don't get that crazy intraday volatility we tend to see with maybe the S&P or some of the other assets. So you can make the reasonable assumption that if the market's trading back at your entry, then it's disaster. So again, since that didn't happen, we got the next volume spike here. So as you can see, volume was dropping off since this one, right? And it was dropping off. We weren't going higher. It was dropping off as the price was dropping down. And if you don't know what that means, I have a course on volume price analysis, which will talk about scenarios like this. Like, what does it mean? Falling price, falling volume equals weak market, right? So stuff like this, I'll tell you. Falling price, falling volume, weak market. It means the people generating that sell side, they're not strong enough. So the market's been ticked lower for whatever reason, right? Maybe to entice more people short who are not paying attention to the volume we're seeing, right? And then all of a sudden we get this higher spike, and that tells us at the end of that day you want to sell. The market convinces people it's still ready to go. Maybe people think it's going to chase this liquidity, and then it breaks down. So the moment we see that breakdown, where we get this big red day, we want to short, right? Because now it's telling us we've seen high volume spike, which means we got what looks like a liquidity hunt, a break back in, and a close below this bar, where presumably, because of the high volume, there were a lot of sellers, right? So if we've closed at the bid, and then we can see here that this bar comes in, tests the upside, and then more problems, right? So even if you were late with the short and you were shorting on this bar, right, where we closed into the tail, right? I always say to you guys that if you ever see price closing into a tail, the next move is normally lower, right? So by now we have a lot of indication that the market's ready to go short again, right? So we didn't trade the liquidity high. So what are we going to do? We're going to short sell, maybe short sell here, right? That again allows for some risk even up to the high. And what happened? Market traded down. If we ended up holding this, we have the risk of gap risk, overnight risk. We don't know, right? In this case, it worked in your favor. You know, market gaps 40 points, you feel like a genius. And then obviously, as you can see, by the time we open the next day, people just want to get out. It's a 40-point risk and they're being pressed. What happens again? Rinse, repeat. Market goes lower, volume's very low, and then we get this spike. And it happens here. So immediately we will be doing something like this, looking for the recovery. We get that here, right? So we can see that we recover on this bar. We can see there was also slightly higher volume here relative to the prior days. So this is all buying, right? And the close above this bar just gave us the indication it is. You could go long here, and now we're running into a gap, right? We could find more sellers here. We don't know. We get a huge volume spike here. You want to sell, right? because the market convinces you it's going higher, breaks down, and this becomes another short trade, right? You can see that here. So the moment we break down, we start closing under this bar. It's evident that we've got a liquidity hunt, pulling back, boom. So if you notice on this shorter daily time frame, you can see those liquidity hunts, right? And based on the volume, because in futures, volume is reported, unlike some of the stuff we saw in Forex. It's decentralized tick volume. It's not, it's not reported volume. This is reported volume. It's contract volume. So what we're seeing is the central order book being reduced to what we call level 1. Basically, it's just the basic recorded information at the end of the day, signifying how many contracts were traded, not knowing if they were long or short, but relative to where they're traded, gives us an idea if it was perhaps short sellers or it was people going long. And the fact that we traded above that doesn't mean that we're going to continue. The prices, in my opinion, are really high relative to where they were before. So if we had buyers here, we're likely to have sellers here. And that means that we're likely to have a liquidity hunt, and then we're looking for the opportunity when we break down, right? And as you can see, there's quite a few points. So what did we learn from this? Gap risk. We learned that. We learned that the best trades to do are when we're coming back after taking out liquidity, right? Those are the best trades. And you would have only really had 1, 2, 3, 4 trades. Sorry. Let's say that you only had 1, 2 trades and so that was it, right? You still done pretty well from the course of May to July, right? You didn't even have to do a lot of trading, right? You should have made some pretty decent money. So that's some of the benefits. If you're coming into commodities, this is what you're supposed to be looking for on the daily frame, right? So in line with some of the steps we spoke about on the last slide. Right, again, let's look at that example we're just talking about. Right, so we saw that where we high volume, came above, entry, sell, get short, as we spoke about. You can either get short here or get short here. I would have gotten short here, to be honest, because this closed below this candle. A lot of confidence here at this stage. There was a hammer candle here. We closed below it, and it was just after significant volume. So I'm not expecting a recovery from here. But again, I could have been wrong, right? So this is some of the risk we take on the trade is, and we could have traded above. And again, this is the reason why there will always be people who are able to sell at much higher prices, because if the market wanted to be, if the algos wanted to manipulate this higher, they just go above here, grab all the buy stops, and that's it. Those buy stops become sell orders, and then we go down, right? And what do we do here? High volume spike, we cover. Right, we saw this, look at the volume, it was low, 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 and then we got this, right, just here, cover. Because now this has formed a liquidity bar, we come down, we take out liquidity here, we take out liquidity here, and then we recover, right? So this becomes a long trade, and we're likely to hold here. What we don't know is, are we going to come and take out liquidity down here? We don't know, but then we go higher, right? It's a bit churny, right? We definitely don't want to get out here, we just want to protect. A bit churny, we see like, ooh, the market's showing us that this could be short, but what's different from what we've seen? This is neither at a reasonable low or high. In fact, it's at a low relative to where we are. So are we going to get short here? No, obviously not. It's too low. We're too short at this stage. So we're just going to watch, right? As long as we don't get taken out at 458, we're fine. That's our risk. Remember, there's gap risk if you're holding overnight. Right, we go, but then as we go higher, right, we get this massive one here and we cover. It's not rocket science. Yes, we made a few points, not as good. It took longer, which tells us the market is weak to the upside. We're seeing a lot of volume coming here. The potential that this thing's going to fall off the roof is extreme, right? And of course, when we look at the long-term bias, what did I say to you for corn? I have a long-term bias, right? That I'm short. I want to be a seller. And that's because of what the long-term was telling us. If you don't believe me, let's go back. Yeah, you can see what short bias is, right? Because we're on this side of the chart now, guys. This is the monthly. So we're here. Our bias is short. At any moment, we're expecting a really massive breakdown. All right, move forward. All right, let's jump out a little bit. Let's look at another commodity. Let's take a look at crude oil. What crude oil's doing, right? Same thing. So liquidity, right? So here we're looking at a monthly chart of crude oil. So We can see commodities, we're talking long cycles. So here's 2009. The next time we got that liquidity hunt was back into 2015. 4-year cycle. Come down, long bias. So we hit the liquidity, pulled back up, closed into this level. I have a long bias. And that was from $33 roughly, all the way to 77. Right? So again, if you were an investor in maybe an oil ETF like USO, then you could have had a good return. If you were investing in oil contracts, again, and you're willing to push this, then what is it? It goes eventually to 68 at this top, right? So again, when we had negative oil, right? So again, for those of you who followed me for a long time, if you go to my Discord server, I predicted that oil was going to trade under at the time I said under $15, right? Because I was looking at the liquidity low here. I said it's going to go under $15. I said if things really hit the fan, we're going to go under 10. And I swear to you guys, there were people who looked at me like I'd lost my marbles, literally. And this was a prediction I was making even way before now. And those days when I was making it, people were thinking, this guy's lost his marbles. Like what? Oil go under $10? You're crazy. You are insane, right? So imagine perceiving that we are trading roughly about $70 odd a barrel, and then telling people that there's a good chance we could go under 10, right? But I would look for 15, no less, right? That's where the liquidity is. Also, I was mindful that we had liquidity here. But if we get down here, then what's stopping them from trading and taking out the traders here? And then we get a big recovery after that crazy move. My bias becomes long, right? This took us from COVID, right? So this was just post-COVID, or during COVID. I say post, it was during. And then look what happens, right? Then we base out. So when it's coming down, there was no hope, right? This was a long bias. So again, you'd want to look for longer. And now, of course, I've got a short bias. Why? We've traded liquidity high at 114. Of course, people are saying we could go high. Yeah, we could take out the prior 140, 160s, right? But I like to see that. Until I see that, I'm not going to change my view, right? Right now, it seems like we've done this. We failed to do that. We're breaking even lower. And if you're looking, we're on a monthly chart, guys. The next move could be big, could be epic. We could be, you have to start to prepare yourself for potentially for us to trade back into these lows, maybe the liquidity low here at 33. You can see where we based out. Right? I don't think we're going to go back to negative, right? That would be unreasonable for me to think that. But we have a short-term liquidity low here, so we might get looped into maybe a range trade for a little bit, and then finally we'll break lower. Or we could range trade, find liquidity, pop, find liquidity, and then eventually we could go higher, take out these guys at 140, 160, and then we're going to get a big collapse then, right? Or we could go lower, form a liquidity low, continue back up and range. Anything can happen. But my bias is short because of what I'm seeing. Right, let's look at how we trade crude oil on the daily. So very similar to the way we perceive corn. So let's look at the volume. So we go here, let's start from this point. So here you can see we had high volume at the top, which is reminiscent with this green bar here. What do we want to do? Let's say we were long, we want to sell, get out, right? We expect the market to go lower. As we get to these lows, we see high volume again, just as we take out a liquidity low and then we consolidate. Already we're quite high, but because we've taken out liquidity, it's a good trade to make, and then all we need to do is sit under the lows. Right? If we come back under, the chances are we're going to break much lower, right? Because it means the sell side momentum is increased. But what I'm looking at is the fact that we're seeing high volume, which is higher than anything we'd seen over the past couple of days. So it stands to reason, based on the way we're setting up, that this could be an upside move, and then we also know that oil can trend a little bit, right? So we know that the volatility of this asset is different from, say, corn, for example. So again, we know that there's a chance that we can trend a little higher. So we go long, right? We buy, entry, stops. Again, as we move higher, we can see that volume increasing. So somewhere between here and here, we'd want to be sellers, right? Now, I'm not going to say we got it picture perfect, right, which would have been here, it could be that you were a seller on this bar, right? We just took out the liquidity high. It's a good place to sell. So you could sell here, sell some here. Now let's say you left it a little late. You even show the short squeeze here at the top, sell some, and then finally you see that high volume here. You want to be a complete seller, right? So you've sold out. Do you want to be a buyer again? No, because you can see that the most volume across several days has traded at the top of the market. What does the market do? It convinces everybody it's going higher, grabs liquidity, closes lower. So the moment you see this bar coming under bids here, you can see where the sellers were. You want to sell short, right? Goes down over 2 days quite strongly, recovers into the high of this bar and then continues lower. Now, whilst you might not have been able to predict that all of this is going to happen, but judging from the volume, there's a high likelihood. And you can also see volume peaking at the top here. So generally, there would have been a lot of sellers, right? Just based on your behavior. Everybody like you is all going to want, they're all going to want to sell. And they're going to look to sell at these high prices. And then we start seeing all of this behavior. So, and of course, we have a bearish bias. So again, all of that is going to serve to tell you that we're going lower, right? It's not rocket science, guys. So I'm hoping that I'm proving that it's actually pretty, it's not that daunting. A lot of the business is patience. I mean, were you able to see this market going higher and still be prepared to wait a couple of days with the view that it's going to trade, test liquidity, and then go higher? Right? And even if it didn't, if it was going lower, were you prepared to wait another couple of days till you see what it did at 74? Or were you willing to wait a couple of days to see what it's doing down here, where it is currently trading now? What were you prepared to do? And if you weren't prepared to do any of those things, then the chances are you got chopped up in all this price action. It's about probability, guys. So again, if we go back to the other lesson we spoke about, which was the probability of ruin matrix, how do we get that high probability up? This is how we do it, right? That's how I've always done it. That's how my trades, my probability is better, and that's how I get more correct trades, and that's how I don't need to kill myself about this huge asymmetric risk to reward ratio that everyone's trying to get. You can see that you get some of that dynamically if your entries are good. But again, you're not going to get like always crazy, because where you're looking to sell is in response to what others are doing, and you want to get out as fast as you can so you don't get caught out. But either way, you can see that a lot of the business, just by looking at this chart, relies on patience. Okay, let's take a look at the S&P 500, which is an index future. Behaves a little differently, and you're going to see that. So again, as you can see, I started here with a weekly, because the monthly on an S&P 500 chart is actually, it's just the symmetrical straight line, right? So it just does this, right? And with minor dips, and that's because stocks are one of the biggest absorbers of inflation. So with money printing, you expect the stock market to just be doing this all the time. You're going to get minor blips like this, which was when we had the tightening cycle, which we're just coming out of now. And looking at this chart, you can see if you were one of those people who was thinking the market was always going to go down because of a recession and all the other stupidness on social media, then sadly, you weren't able to take advantage of this market. So from where we are now, I don't look at the monthly chart for the S&P because it always looks bullish to me. I just can't see a bearish play, which means that since we have a continuous bullish bias, it almost seems, until we have a major event, which only lasts like maybe a couple of weeks or months and everyone buys the dip, it just makes sense to position yourself to get into good long trades. But whilst we were going through an obviously knowable bear cycle, then it makes absolute sense to position for the short side, because we know the Fed is tightening. The Fed actually told everyone in the goddamn world that they were going to tighten. What does that mean? Stocks will go a little lower. They're not going to crash, right? A lot of people on Twitter are like, oh, it's going to crash. No, it's going to correct a couple of percent point. It's just a couple of percent, that's all. So we started a nice little correction, and we could have played the swings, but we're going to have a bearish bias. And what does that look like? So let's start here. We had massive volume up the top, right? Obviously, well, that goes without saying. I think we're seeing a pattern here is that if we have high volume, top of the market, then we're going to get a correction. So we're seeing a pattern. Massive volume spike, we start to break down. We start punching in a few lows, even higher volume here. So this is some of the differences you're going to see. So this bar here was this volume. So we expect that we're going to get a liquidity hunt. We get that, we pull, we sustain, we want to find a bid price. The S&P is quite volatile. So you don't want to chase into a trade. It's not like corn. You know, you're not just going to get a few ticks. You get like a lot of ticks with the S&P. So you buy just somewhere midway to this bar. You get long, lows below this bar. Your target is above the liquidity high. Because you know that we're not in a bullish framework. The Fed has just told us we're tightening. We've seen sellers already letting go. We're just getting short-term traders now, short-term volatility. This was a good up move for the S&P, right? Just get out of your trade here. But then get short, sell. Market breaks. We can cover some at the liquidity low, but we know the Fed is tightening, so we're probably going to go lower. But we're going to cover some here to protect, right? Break even the trade. And then wait. Then it starts to go lower. And as you can see, we start to take in some volume here, which is a little bit more. Then you can start to cover now. Here you start thinking about getting out. We get a big move up, which is more than likely the short covering we're talking about, guys. Getting out here. See a lot of people doing that, or a lot of big funds. All right, what's down here? It's liquidity low. We recover above, but we know it's a bear cycle. But let's say you went long, right? You waited for a slight pullback. You went long to catch the liquidity high here, and you were wrong. Okay, well, we broke down. We took out the low. It made sense. You stopped out of your trade, right? We go a little lower, and then we get this massive volume spike. Great. Good buying opportunity. The likelihood is we're going to take out at least this liquidity high. That's what happens. We go up. What do we get? Slight volume spike. Just slight relative to prior days. I didn't mark it out here, but just slight. Right, we post a high. So now we're seeing a bit of a pattern. Yeah, A, B, C, D. Oops. Is it going to be? Are we going to get a wedge? We don't know. But we get a liquidity high here. We see the volume. We know, okay, let's wait. We see a bit of a breakdown. A good short level. Right? Just short right here. You're aiming for liquidity low. And then look what we post here. One of the largest volumes we've ever seen since 2021. Okay. This is what we're talking about. This is the point where we want to rev our engines. We want to get ready because you're going to go heavy. What's the sentiment you're going to start to see, right? People talking about bear markets, biggest crash of all time. Look, I could pull up articles for you now. I should have put some in this presentation just so you can see how divisive the whole market is. But go to Google. Actually make that as an add-on to your assignments or homework. Go to Google. Look at this particular week, these weeks, right? Which was around about October. Please go to Twitter. Find tweets around about October. You know, the first couple of weeks in October. Find news articles and see what they were saying about the US economy, the markets in general. It was so negative that you're probably going to have nightmares from just hearing what they're saying, right? Obviously, we're trading at technical liquidity low, so there are going to be a lot of sell stops here already. And then there's panic. So when we saw this bar do this, that, and everyone said, this is it, we're finished. We've broken out the low. This thing's going to go all the way to 2000. It's finished. And then look what happens. We recover. Entries should be, so the moment we start to see the bull market chase up that week, and we start to get stronger and stronger into 3,700, boom, we want to hit long straight away. We've seen the liquidity hunt, right? We've been at it for some time. This has got to be the bottom. End of story. Right? We also know there's some liquidity here as well. We can tell from the volume, right? And we just traded under that and recovered. I wonder. Entry, stay long, stops below the low. This is your moment to shine. You might have had a bad trade here. You might have had a good trade if you took it. You might have had a slightly good trade here. But now you got a stellar trade. Now, what if you were dollar cost averaging, right? What if you were just buying into the S&P because you can afford to, and you just wanted to ride this? Well, you should have been adding. Here we get massive volume, right? We consolidate. We've taken out liquidity here, come here, and now we're posting volume here. It's neither high nor low. That tells you that this is a lot of people buying the panic. Again, go to Google, see what was being said, particularly this week. This would have been in sort of March, just before April, right? What were people talking about? That's your entry, right? The moment we hit this volume bar, we started to close above it. We're closing into the high of the tail. You want to get long here, entry. And then right up here, we can start to sell, right? Get out. We're just above the liquidity high. So if these guys are right, we're going to get another collapse. It will be now. We've seen some volume. It is nowhere near what's sitting here, but some. So we're expecting a decline. What do we get? We get a liquidity hunt. We come back under. I don't want to short because I know the cycle. The interest rates are going to stop. They're not going to hike it anymore. Everything, inflation's down near enough 2%. I'm not going to short the S&P. Sorry guys, I'm not doing it. You're not going to be able to pay me to do it. Sorry, I'm not doing it. I've seen sellers here, but I've seen nothing driving this market here. And as we get to the underside, you can see that volume starts to peak. Right, so people are buying this dip. You know, this is obviously going to be a lot of speculators coming in a bit late in the game when the smart money already here. Some of them are sold here and we're going higher. Guys, what do you think the next step's going to be? It's a big question. Probably going to take out the liquidity high here, just above 4,900. Right, don't believe me? Well, take a look at your, you're probably watching this. I'm going to put this lesson up maybe the next couple of days, 2-3 days maybe. Yeah, that's where it's going to be. So we're going to be up here, no doubt. And yeah, let's see what happens. Right, we're already trading a liquidity high here, so we did it before. We didn't really get under. Now we're up there for real. So let's see if we cut back down. But again, I expect that this close, we're going to be up here in no time. And from there, that's when we need to get concerned, because the liquidity high, we might consolidate a little bit or come down, right, and take out the liquidity low here before going higher. You see what I'm getting at, right? And what do you think is going to happen if that happened? Everyone's going to tell you to be a seller here under 4,100 when you should be positioning to get long as soon as we can get a recovery. So do you see why so many people are going to lose money in this markets? Because they're never prepared. Some people are buying up here. I mean, why are you doing that? There's some volume coming in now that's pushing this, but again, this is likely people selling as opposed to people buying extra, right? Some people are buying, of course, because they're buyers, but they're not going to be professionals, right? If you're a professional, you're in and you're holding and you're waiting for that correction where you want to either add to your position when we come lower, right? Or if we consolidate and we create a new liquidity low, those are the levels of interest to you, right? But you should have been bullish from October, right? October last year. Why weren't you? The news. That's why. Anyway, let's pivot back to corn futures. Let's say you wanted to be an intraday trader, right? Let's say you wanted to be an intraday trader. Well, look, let's have a look, right? Concept's the same. The good news about corn, and if you wanted to be an intraday trader, is that, and I did say to you guys, if you're beginning, you're just starting out in the game, then these are the assets you want to trade. How many people do you know within your immediate trader circle, if you know any traders, that effectively trade corn? Most people don't know anybody. All right, so let's take a look at this. So what do we see? Market opens 2:30 UK time, right? In the US, I believe it's 8:30 Central time. Market opens and you see we post very big volume here. It was a high, 487. We start to go down. We start to break below the low. You sell short. Right, remember this market closes. Right, it does have an overnight, but like I said, margins go up overnight. Can you afford the overnight risk? So liquidity generally dries up, and you can see that from the pattern of the charts. There's not a lot of quoting. So the cleaner candles mean the session's liquid. It's a more liquid session, right? That's why you've got all this cleanliness. We go down, we see higher volume here, cover, we get a liquidity hunt, we recover. It gets late in the day, no one wants to be in a position. So again, if you can handle the overnight risk, for example, you can see that here, you can enter. There's a lot of volume trading this just after liquidity hunt. So you might want to hold the overnight into the next day and then sell on the open, right? You see the volume here, sell on the open, we get a big spike, we take out the liquidity high, we start to struggle, right? We can see there was additional volume here and we're struggling. It's a good place to sell short. We get a little lower, you want to cover. There could be gap risk overnight. We see that. It gaps overnight to the downside, fair enough. At this stage you want to cover and then you want to wait because this is all overnight risk. Right, so you sold short during the intraday, covered after you'd sold your position on the open. Right, it's very simple. Then we come into the next day and you can see the market keeps trending lower overnight. We open, panic. Right, the guys who couldn't access the market overnight, there are a lot of brokers that don't allow their traders overnight access, for example. Right, and then, you know, correct me if I'm wrong if that's changed, but I know back in my day there were a lot of traders who couldn't really do it overnight, especially retail. Now you see us drop on the open, massive volume, and we start to recover. So again, this is what you're looking for, right? So we get a bit of a spike. This is huge, it's a huge volume, and then we start to recover. Now what's happening on this day? This is a dynamic chart, right? So this is Fed day. Fed interest rates are going to happen later in the day. So when I see stuff like this, we could get a liquidity hunt. So we want to look and see, right? Because what's down here, guys? Check this out. What's down here? The market's hunted liquidity and it's recovering. So if we can recover back into these prices, which is over 480, then I want to be a buyer. I'll buy at 480. And what am I looking for? For us to go back up and spark off a trend to that least liquidity high, the overnight, right? Just about here, 485, 486, which is typical. Maybe less, maybe even up here, back above this candle bar, whatever. But I'm going to be looking at these levels because it's Fed day, right? It's during regular trading hours. So by the time we get to the Fed announcement, a lot of this should be discounted in. So if you want to go back and have a look at your charts on corn, if you know, again, if you go to TradingView, you can see it's the CBOT ticker and CZ is the ticker for corn. And if you can just go on and put CZ 15-minute chart for the intraday continuous contracts, and then just see what's happened, right? See if we did follow through on this particular day, which is the 13th, right? Yeah, that's it. Right, now let's talk about the S&P 500. Again, futures are a little bit easier than Forex. It's just how it is. It's the nature of this market. So here we have a liquidity low. This is a 1-hour chart, the S&P 500. This is what we want to look at if we're going to intraday it. I don't care what anyone says, 15-minute, I look at a 5-minute, I look at 3-minute. For me, I start with the hour, right? That's where the moves are. I'm going to have a look. I'm going to prove it to you. So here we have high volume trading on the open. With the S&P, you're always going to see high volume at the NASDAQ open, 2:30, that sort of time frame, right into Chicago. So the 2 p.m. bar is going to be the highest volume bar. Right, so we want to pay attention to what's going on. So this market's been dropping, high volume bar steps in. Right, sets a low, recovers, trades around here. We're going to start here. So the market's been going up, and then on the open, you can see here, it's high volume here, liquidity hunt here, liquidity hunt above the high, come into the open, we start to sell off, right? So we see pre-market, bit of volume, even higher here, we're closing, sell short. As we get to the bottom, huge volume, cover that short position. You've got a profit. Market's now traded liquidity, so there's a slight liquidity hunt. It settles overnight. Look at the time, pre-market. This is in Europe. I'm using the European time zone. So it's about 11 a.m. in London. Market steady. recovers above the liquidity. See that line here we drew? So we covered above. That's our cue that we could get a bullish US session. Now, when you're more experienced, you'd put on your trade in Europe, right? The more experienced traders in the US, they get up in the morning and they trade that pre-market into Europe for the S&P, because they know they're going to front run all of you guys in the States that are retail, because you're going to wake up in the morning to trade this. They've been up early, right? They've seen the spike, the liquidity hunt. They might not have gone in overnight. Remember, we spoke about those overnight margins as well. And during these times, they're still overnight margins. But the more experienced guys are going to take advantage of that. Whilst, again, with if you're trading CFDs, you have access to that, then you're going to be able to trade in Europe without any consequence. Margin rates are not going to change on a CFD platform, which is what's attracted a lot of traders to indices, because it's the closest to the futures product on CFD platforms. No one wants to trade Forex anymore. Well, that's wrong. A lot of people do trade Forex, but a lot of the guys who want it easy tend to gravitate a lot to futures. So again, you can see that traded above entry, right? So this is the market open. Again, you could just get in pre-market, or as the market opens, just fire yourself long on the open, and look what happens. We go up, we get a huge volume spike higher than this one. We want to sell. Right now, if you're smart, if you go back, you'll see there was high volume here, and high volume here. There are too many buyers. So if you're smart, you might not sell here. You might wait for the liquidity high, but this is now the market's sort of winding down overnight. And what do we talk about? Overnight gap risk, short squeeze. Why did that happen? You can see the volume spike here. A lot of people were selling. They were shorting, maybe thinking, I don't know what they were thinking. Let me put that. I have no idea. But anyway, there's liquidity high. There's liquidity up here. They didn't even wait. They started shorting. That's a classic sign it's dumb money. Right, they're getting heavily short before we trade a liquidity high. And even if they get lucky, it won't be long before they're going to get stomped out anyway. Right, so dumb money, it's the classic sign where you can see the volume was light prior to the previous day, where prices are already closing where the big shorts were, which was this day. We can already see that the buyers here were already surpassing the shorts here. We can see that there was existing buyers here that obviously had to struggle to stay in this one, because this is all liquidity, so they were strafed. So these guys still holding on, which overnight we can see there wasn't much volume. It's probably waiting, and then they get a recovery, and then we get solid closes. Look at this tail here, and we closed up solid. Why on earth do you want to short against this? Overnight as well, keep that overnight risk. So anyway, I wasn't surprised to see there was this massive gap risk, because there were too many people getting short overnight. So again, these are things you can see on the chart and take action. Right, so if you notice that, you can say, well, what's the worst that can happen? If I was long here, I break even my trade, and then hope that, well, look, the highest price was here, there was hardly any volume in it, and everyone's short just below the high. It looks like desperate dumb money. Or it could have been sellers, people just, covering some of their position ahead. Right, but either way, you could take the risk and say, well, if we open in Asia, we might get a strong move, and instead we get gap risk. So market opens in Asia and we open up here. Fantastic. So you might not see it, but as soon as you wake up in Europe, which would have been about here, in my opinion, you just want to come out of that trade. That's what I would do, right? So that's another example there of how you can sort of trade the S&P. So it's similar. My point here is that everything I've showed you is proof that it's all similar. The algos do the same thing. So you have to start thinking like them, and that will put you in a really good position. All right, so some homework, guys. So exercise 1, we're going to pick different futures contracts, maybe wheat, soybeans, or bond futures, and let's see if you can simulate. Practice what you've seen on that I've showed you. Follow the same steps I've showed you using these assets. Whether you're looking to do it intraday, I've showed you how you would trade intraday, how you would trade sort of swing on the daily with the commodities, and I've showed you how you look at some of the agricultural commodities over a long term, say over a month. I've showed you all of this. Exercise 2, head to the CME website. look at the contract specs for each futures. If you're going to trade futures, you need to know the contract specs. What's the tick price? So for corn, it's $12.50 a tick. I think soy oil, it's $10 a tick. Soybean futures, it's $12.50 a tick. Bond futures, it's $1,000 a point. So it's 30. And guys, correct me if I'm wrong. It's been a while since I've done all these tick prices, but I believe it's $33 something a tick, right? Yeah. Anyway, you can calculate it. It's $1,000 a point. It ticks in 1 over 32 is the last tick before we get a point, right? So if we can work it over 130 seconds, then you get what it is. So again, but that's why I said go look at the contract specs. Can't remember it all here. In oil, of course, we get oil. It works out to be the same. It's about, depending on the contract side, 10 cents a tick, so $1 a tick, $10 a tick, right? So it's $1,000 a point for crude oil. So 100 cents, $10 a tick, 1,000 points, right? So they're all kind of similar, with a few maybe ticking slightly differently, but they're all somewhat between sort of $10 a tick or $12.50 a tick, right? So with the exception of bonds, I think the 10-year T-note is about $16. It's 25, I think, a tick. So those are the ones that are different. It's largely the bonds, but everything else tends to tick around about the same. At least the ones that you're going to trade. The S&P Mini is $12.50 a tick equally. If you're trading the big S&P contracts, it's $25 a tick, I think it is. So it's $250 a point. So as long as you can kind of get your bearings around that, then that's it. You're pretty much fine. There you go. Anyway, awesome stuff, guys. I hope you enjoyed the lecture. This has been a big one. This has been a huge one. Futures was always going to be massive. And, we've scratched a lot of the basics you need to know. I won't say we barely scratched the surface. We kind of really dug deep, but there's a lot to know about futures, and doing some of this homework is really going to help you get to that place. So again, if you want to go over the lesson again, please do. It will teach you so much. And I hope you appreciate this. And if you do, just share, keep subscribing to the channel, share what we've got here. Because again, if you don't share it, YouTube algorithm, it's not going to know it's important. There's no clickbait here. It's just literally the lesson title, so you guys can find the lessons easier. And the thumbnail, well, it can't be anything more interesting. So all the things that YouTube prioritize, sadly, is not going to be in this video. There's no talking heads in here. It's just me showing you what to do and teaching you a lesson. So all of the things that the algorithms look for, they're not going to be in this video. So you've got to show other people that, hey guys, you're struggling. If you're on a forum or something and someone's really struggling, show them this. It's free. There's no charge. And that helps them improve their journey. So everyone can give the finger to the guys who are misleading everyone everywhere, and hoping to also make a healthy profit doing that. But anyway, awesome stuff, guys. Till the next lesson. See ya.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?